The stock market might seem scary at first. You might have heard stories of people losing all their money really fast. Also, there are confusing words like convertibles, options, and zero-coupon bonds. So many people wonder if a regular person can actually make money in the stock market. This summary will make investing easier to understand. Before you can grow your money, you need to save enough to invest. And before you invest, you need to know how to lower costs and keep your money safe from risks you don't need to take. You'll also learn why safe investments are important, especially when you don't have a lot of money saved up yet. Once you have enough money saved, this guide will teach you the basics of stock trading. You'll learn how to decide when to buy and sell, and how to look at other choices besides just buying shares of companies. As you go, you'll also learn about different ways to invest and proven rules that can help you stay away from common errors. Here's the truth. The money you make from your job is usually not enough to make you truly free with your money. It might not even be enough to buy the house you want, a good car, or pay for your kids' school. That's why investing is not just a choice. It's a must. The good thing is, the stock market is not as hard as it looks. Once you know the basics and use your good sense, you'll see that smart investing is not just for people who work on Wall Street. It's for anyone who wants to learn. Saving a little is like earning twice as much. Many people don't know that the money they get from investments is also taxed. This can be a costly mistake, especially if they don't know how tax brackets work. For example, if someone makes $10,000 a month and pays $1,000 in taxes, it doesn't mean they're in the 10 tax bracket. It just means 10 is their average tax rate. But really, income tax works in steps, so you pay different rates on different parts of your income. The first few $1,000s might not be taxed at all. But as you earn more, the tax rate also goes up. In the US, some people end up paying as much as $35 on the last few $1,000s they make. If you work for yourself or own a business and don't live large, your highest tax rate can be 50. Now, picture yourself just below that 50 mark. You invest some money and make 1,000 extra. That extra money pushes you into the higher tax group. Then, the government takes 500 of that extra money. Half of what you earned from investing is gone. It doesn't help you, it just gives more money to the government. This shows why just trying to get rich by making more money doesn't always work. Sometimes, spending less money is a better and stronger way to get ahead. For example, if you don't buy the newest iPhone and save 1,000 instead, you don't have to pay tax on that money you saved. That's why saving $1 is better than earning $1. If you stop and look around, you can find many ways to save money. Take wine, for example. Many Americans like to buy a bottle of red wine each weekend. A good bottle costs about 10, but if you buy a box of 12 bottles, you often get a 10 discount. This means you pay about 108 instead of 120. That saves you 1 for each bottle, or 52 each year. Let's look at this, like it's an investment. Normally you spend 10 each week on a bottle. But if you buy in bulk, you spend 108 all at once every 12 weeks. That 98 you spend at the start is like your investment. And the 52 you save each year is your return. That's a return of more than 50, which is better than what most people earn from stocks. Another easy but good way to save money is by not paying extra interest on your credit cards. About 60 of Americans pay over 18 interest on their credit card balances, even if they have money in a savings account that earns only 2. It's like losing money while trying to save. If you are smart with your credit card, you can actually earn money. Some cards give you back up to 2 of every dollar you spend. Look for cards that give you bonuses at the end of the year or discounts on hotels, restaurants, or flights. If you use them right, these small benefits can add up. You should also be careful with your bank loans. Always check your interest rates and monthly payments. The writer Andrew Tobias once got a $400,000 loan at 7.5 interest. A year later, the bank lowered his rate to £7, but his monthly payment of $4,670 seemed a bit off, about 10 more than it should have been. It seemed like a small thing, but when he looked closer, he found out that the bank had secretly signed him up for a $7,000 insurance plan. If he hadn't checked, he would have paid too much without knowing it. Young people often dream of having nice cars and are tempted to lease or get long-term loans. But cars don't last forever. After some years, you either trade them in or pay more for repairs. That's why buying a car with a loan isn't always smart, unless you can really pay for it right away. This doesn't mean you should never have a car. It just means you should wait until you can really afford one. There are many gas-saving used cars you can find. A cheap car now can help you save enough to buy a new one later without owing money. As you get older, what's important to you changes. Fancy cars and nice things don't seem as great. Instead, healthcare becomes a big cost. A good way to lower these costs is to ask your doctor about cheaper, generic medicines. Big drug companies often sell name-brand drugs that cost a lot. But smaller companies sell the same drugs for much less. You can even ask your doctor if you can buy bigger doses and cut them in half. For example, Andrew Tobias saved 50 on his heart medicine by buying a stronger dose and taking half a pill each day. Of course, the best way to spend less on medical care is to stay healthy. And being fit doesn't have to be costly. Many people waste money on gym memberships they hardly ever use. Unless you are a bodybuilder or play sports, you can stay in shape by doing simple exercises at home, like push-ups, squats, and crunches. Just walking around where you live can really help your stamina. For most people, fancy gym equipment and fees are not needed. Just like being healthy physically, it's important to keep your mind sharp and learn new things your whole life. Reading is a great way to grow your mind, and the cheapest way to do this is by joining a library. In many places, a whole year's membership costs less than buying just 2 or 3 books. That's a really great deal for helping yourself grow. The case for being careful. There's a well-known saying in the money world: one big risky gamble can make you more money than being careful your whole life. And sometimes that's true. One brave move can change everything. But really, most people never find that one amazing gamble, especially if they don't work with money for a living. For most of us, there's a better saying to remember: you get what you pay for. If you want big wins, you have to be okay with big risks. But that doesn't mean you can't make good money by being careful. Actually, for regular people, being smart is often better than trying to get rich quick. Yes, putting money in stocks can give you more money than safer choices. But before you do that, know what you're getting into. You might lose money for 5 years before you start making real money. That's why stocks are only good for people who already have a lot of money saved up, enough to pay for the next few years, no matter what the market does. If you're just starting and don't have much savings yet, there are 2 types of safe investments you can think about: short-term and long-term. Which one you pick depends on when you need to use your money. Let's start with short-term choices. One of the safest is the money market fund. These funds take money from many people and lend it to governments or big, strong companies. The idea is to make sure the loans are paid back and the interest earned is shared among the people who invested. There's no promise of regular monthly payments, but if you pick a fund with low fees and a good name, usually offered by big banks instead of unknown financial companies, you'll be safer. Then there are treasury bills, which many see as some of the safest short-term ways to invest money. Basically, you're lending money to the government. In the US, you can buy a treasury bill for as little as $100 and sell it back after 1, 3, 6, or 12 months. These bills often pay good interest rates, and because the government backs them, they're about as safe as you can get. For goals that take longer to reach, there are treasury notes and treasury bonds. These are like treasury bills, but they last longer. Notes usually mature in 2 to 10 years, while bonds last from 10 to as long as 30 years. Stocks usually do better than bonds over time when it comes to returns, but when the economy is doing badly and interest rates are high, treasury bonds become a safer, more appealing option. But there's a catch. The money you make from treasury securities is taxed. That's where municipal bonds come in. These are like treasury bonds, but cities sell them instead of the national government. For example, you might be lending money to New York City instead of the whole country. Municipal bonds often don't have taxes and are almost as safe as treasury bonds. Why? Because national governments hardly ever let their cities go broke. But if a city does have money problems, you might not get your money back for a while. These bonds are safe, but not always easy to sell quickly. It can take years for cities to fix their money problems after a crisis. Another long-term choice is convertible bonds, which are loans you give to a company that pay interest regularly. But here's the interesting part. You can turn them into company stock. This means you could make a lot of money if the company does well. If the company is having trouble, keep getting the guaranteed interest payments. If the company is growing, you can change the bond to stock and sell it later for more money. Of course, you need to do your research to know when to switch. If you don't have the time or want to learn about it, it's best to avoid these bonds. There's one more type of long-term investment to think about: zero-coupon bonds. These are different from regular loans. You don't get interest over time. Instead, you buy them for less money and later get more money back. For example, in 1994, Andrew Tobias bought zero-coupon bonds from Revlon, a makeup company. He paid only 43 cents for each bond, and 4 years later, they paid 1 per bond. That's a big return, over 130. The problem: if the company failed, he would have lost all his money. But the bonds were so cheap that the risk seemed small compared to how much he could gain. Safe investments like these are great when you're starting out, but don't think they'll make you very rich. Even if you save 20 of your pay for 40 years, you might only have enough to pay for about 8 years of living when you retire. And that's before taxes and rising prices take away from your savings. At best, safe ways to invest might make your retirement money last a few more years, but they won't be enough by themselves. To really grow your wealth, you need to be okay with the risks of the stock market. The good thing is, those risks are easier to deal with when you've already put some of your money in safe, sure investments. That base gives you the confidence to take bigger steps and get through any problems that come up. Now let's talk about the stock market. Now that you've saved a good amount of money, and some of it is slowly growing through safe investments, it's time to think about the stock market. Why? Because putting money in stocks is one of the best ways to stay ahead of rising prices. Rising prices are like a hidden thief that makes your money worth less over time. Think about when you were a kid. Didn't things seem cheaper? That's inflation. If you bought treasury bonds 10 years ago, you might be sad to see that prices have gone way up, but your bond interest hasn't. Now what if you had invested in a soap company instead? Over 10 years, soap prices probably went up. The company's earnings and worth would have grown with inflation, maybe even faster. This shows why the stock market can help you beat inflation. Let's look at some real numbers. A study looked at how U.S. Treasury bills, corporate bonds and stocks did from 1926 to 2015. Treasury bills made about 3.7 each year. Corporate bonds made 5.9, but stocks did the best at 9.8 each year. To give you an idea, if you had put 1,000 into government bonds in 1926, you would have about 20,530 by 2015. But if you had put that same 1,000 into the stock market, it would have grown to over 4 million. And it doesn't stop there. Stock investing can be good for your taxes. When you sell stocks for more than you bought them, that money is called capital gains, and it's often taxed at a lower rate than your regular income or bond interest. Also, some companies give part of their earnings to their shareholders as dividends, which are also taxed at a lower rate and don't make your stock worth less. People are often scared of the stock market because it seems hard to understand, but when you break it down, there are only 2 main ways to make money from stocks: dividends and capital gains. Everything else in investing is based on these 2 ideas. In the same way, there are only 2 things that make stock prices go up or down: fear and greed. Prices go down when investors worry that a company won't do well and quickly sell their stocks. Prices go up when investors get greedy. They think a company will grow a lot, so everyone buys its stock. The first secret to smart investing is to buy when prices are low. But many people do the opposite. They buy when the market is high. The problem is that when prices are already high, there is less room for them to grow. The best time to buy is when prices are low and the stock has room to go up. Also, never put all your money into just one kind of business. Stocks in the same area usually go up and down together. If Microsoft does badly, Apple might also do badly. To keep from losing a lot of money, spread your investments across different kinds of businesses. It might seem strange, but the most popular stocks are often the ones you should avoid. If everyone is already investing in a company, there is not much more to gain. Those stocks are often the first to drop when people stop being excited about them. Maybe the most important thing in investing is knowing when to sell. Many people get scared and sell their stocks just because they hear someone say the market will crash. That's not the right thing to do. You should only sell if you think the stock will crash, if the price is much higher than what the company is really worth, or if it doesn't make sense to keep it anymore. Of course, not every stock you buy will do well. Sometimes, right after you buy it, the company starts to lose money. That's why many people invest in mutual funds. These funds are run by money experts who gather money from many people and invest it wisely in different stocks. It's true that some companies might fail, but the market usually grows over time. A good mutual fund invests in strong companies in different areas. Even when times are tough, using strategies like dollar cost averaging can help you do well. Let's say you decide to invest in a mutual fund called SCOF Illustration Fund and decide to put in 3,000 each year. In the first year, the stock price is 25. In the second year, it goes up to 45. In the third year, it falls a lot to 5. Then in the fourth year, the price goes back up to 25. Over those 4 years, you put in 12,000 in total. Each year, your 3,000 buys you shares. In the first year, you get 120 shares. In year 2, because the price is high, you only get 67 shares. But in year 3, when the price is very low, your 3,000 gets you 600 shares. So you have 907 shares in total. Now, if the stock price stays at 25 again, your 907 shares are worth more than 22,000. Even though the average stock price over 4 years was 25, the same as when you started, you've made more than 10,000 in profit. Why? Because you bought more shares when the price was low. That's how dollar cost averaging works. You invest the same amount regularly, no matter what the market is doing. Over time, this way of doing things helps you buy more when prices are low and less when they are high, which makes your average return better. Choosing to ignore your broker. A stockbroker is someone who has a license to buy and sell stocks for you. As a normal investor, you can't trade stocks yourself. You need a broker. Most brokers also give financial advice, telling you when to buy or sell and suggesting which stocks to choose. What's the problem? Very few brokers do better than the market over time. And the really good ones, the kind that rich people trust, cost more than 500,000 a year. That's too much for most people. Still, you'll see lots of ads promising cheap brokers who always beat the market. But often, these claims are more about luck than skill. Imagine this test. You get 256 people in a room and flip a coin. Half pick heads, half pick tails. 128, guess right. Do this 8 times, and the rules of chance say one person will get it right every time. Does that mean they're smart or just got lucky? The stock market is like that too. Each year, half of all brokers do better than the market, and the other half do worse. Now, what if the brokers who didn't do well didn't talk about their bad years, and only showed off their best years? That's how many brokers sell themselves. They act like they've found a secret trick, but really, they just had a bit of good luck. Another problem. Brokers usually don't have much time to really study the market. They're always trying to find new customers, sell investment plans, call people, deal with papers, and make trades. Really, a lot of them are just salespeople. The people who actually study the market are called investment advisors, not brokers. But even the experts don't always get it right. Here's a story. In 1967, the people at Forbes magazine tried something fun. They selected a stock at random, then asked people to write in and tell them if they thought the stock would go up or down. Of course, about half the letters predicted it would rise and half said it would fall. Then Forbes chose another stock and did it again. They kept doing this for years, tracking only the people who had guessed right every time. By 1976, they had a group of people who had picked correctly for 8 years in a row. Forbes wrote an article about these people, calling them investment superstars. The problem was they had only chosen the people who were consistently right out of a much larger group. Most of the people who wrote in probably didn't do so well. It just looked like these superstars had a special talent, but it was really just luck. This shows how random chance can sometimes look like skill. So how should you pick a good broker? Look for someone who puts your needs first, not just their own. That's why fee-only financial advisors are a better choice than commission-based brokers. Fee-only advisors get paid directly by you, so they don't have a reason to push certain investments that might give them a higher commission. Commission-based brokers, on the other hand, make money when you buy or sell something. This can lead them to suggest things that are good for them, but not necessarily good for you. It's like going to a doctor who gets a bonus for prescribing certain medicines. Would you trust that doctor to give you unbiased advice? Another thing to watch out for is brokers who try to scare you into making quick decisions. They might say things like, "This is a once-in-a-lifetime opportunity," or "You have to act now before it's too late." These are just sales tactics to get you to buy something without thinking it through. A good broker will give you time to consider your options and won't pressure you to do anything you're not comfortable with. Remember, investing is a long-term game. Don't let anyone rush you into making decisions that you might regret later. The best way to protect yourself is to do your own research and understand what you're investing in. Don't just rely on what a broker tells you. Read books, articles, and financial reports. Learn about different types of investments and how they work. The more you know, the better equipped you'll be to make smart decisions. It's also a good idea to diversify your investments. This means spreading your money across different types of assets, like stocks, bonds, and real estate. That way, if one investment does poorly, you won't lose everything. Diversification is like not putting all your eggs in one basket. It helps to reduce your risk and increase your chances of success over the long term. Finally, don't be afraid to ask questions. A good broker should be willing to explain things to you in a way that you understand. If they can't or won't answer your questions, that's a red flag. Investing can seem confusing, but it doesn't have to be. By understanding the basics and working with a trustworthy advisor, you can take control of your financial future. Remember, it's your money and you have the right to make informed decisions about it. Don't let anyone pressure you into doing something you're not comfortable with. Take your time, do your research, and invest wisely. 5. The importance of patience and avoiding emotional decisions. Investing is a marathon, not a sprint. Many people get caught up in the short-term fluctuations of the market and make emotional decisions that they later regret. The key to successful investing is to remain patient and avoid letting your emotions dictate your actions. One of the biggest mistakes investors make is trying to time the market. They try to buy low and sell high, but it's nearly impossible to predict when the market will reach its peak or its bottom. Studies have shown that market timers consistently underperform investors who simply buy and hold. This is because they often miss out on the market's best days, which can have a significant impact on long-term returns. Another common mistake is panic selling during market downturns. When the market starts to fall, many investors get scared and sell their investments to avoid further losses. However, this often locks in those losses and prevents them from participating in the subsequent recovery. It's important to remember that market downturns are a normal part of the investment cycles. They happen from time to time, and they don't necessarily mean that your investments are doomed. In fact, market downturns can be a good opportunity to buy more investments at a lower price. As Warren Buffett famously said, "Be fearful when others are greedy, and be greedy when others are fearful." Of course, it's easier said than done to remain calm during a market crash. But if you can resist the urge to panic sell, you'll be much better positioned to achieve your long-term financial goals. To avoid emotional decision-making, it's helpful to have a well-defined investment plan. This plan should outline your investment goals, your risk tolerance, and your investment strategy. Once you have a plan in place, it's easier to stick to it even when the market is volatile. It's also important to avoid checking your investment accounts too frequently. Constantly monitoring your portfolio can lead to anxiety and impulsive decisions. Instead, check your accounts periodically, such as once a month or once a quarter. This will give you a better perspective on your long-term progress and help you avoid getting caught up in the day-to-day noise of the market. Finally, it's helpful to remember that investing is a long-term game. Don't expect to get rich quick. It takes time and patience to build wealth. But if you stay disciplined and avoid emotional decisions, you'll be well on your way to achieving your financial goals. 6. The power of compounding and long-term investing. Albert Einstein once called compound interest the most powerful force in the universe. Compounding is the process of earning returns on your initial investment, as well as on the accumulated interest or profits. Over time, this can lead to exponential growth in your wealth. The key to harnessing the power of compounding is to start investing early and to reinvest your earnings. The earlier you start investing, the more time your money has to grow. And the more you reinvest your earnings, the faster your wealth will accumulate. To illustrate the power of compounding, consider the following example. Let's say you invest $10,000 in an account that earns an average annual return of 8. If you leave that money untouched for 30 years, it will grow to over $100,000. That's more than 10 times your initial investment. Now, let's say you start investing that $10,000 10 years later at age 30. If you still earn an average annual return of £8, your investment will only grow to about $46,000 by the time you're 60. That's a significant difference, simply because you started investing later. The power of compounding is even more pronounced over longer time periods. If you invest that 10,000 at age 20 and leave it untouched for 50 years, it will grow to over 469,000. This shows how important it is to start investing early and to give your money as much time as possible to grow. In addition to starting early, it's also important to reinvest your earnings. This means taking any interest, dividends, or profits that you earn and using them to buy more investments. By reinvesting your earnings, you're essentially earning returns on your returns. This can significantly accelerate the growth of your wealth. For example, let's say you invest 10,000 in a stock that pays a dividend of 3 per year. If you reinvest those dividends back into the stock, you'll earn even more dividends the following year. Over time, this can lead to a significant increase in your overall returns. The power of compounding is one of the main reasons why long-term investing is so effective. By investing for the long term, you give your money more time to grow and to benefit from the effects of compounding. This can help you achieve your financial goals, such as retirement, buying a home, or paying for your children's education. So, if you want to build wealth, start investing early, reinvest your earnings, and stay invested for the long term. The power of compounding will do the rest. They put a copy of the New York Times business part on a wall and threw 30 darts at it. They put money into whatever business the darts hit. Over the next 15 years, their money grew by about 240. The whole market only grew by 35 in that time. It's interesting that half of all money advisors did worse than the market in those years. So what does this mean? Brokers and advisors both get paid when you make a trade. This means that every time you trade, some of your money goes to them, even if the trade doesn't help you. These fees are often hidden, but they add up quickly. Andrew Tobias once figured out his own broker fees for a year and found they were his second biggest cost after rent. Of course, brokers want you to trade as much as you can. That's how they get paid. So, don't think they will tell you to just wait and do nothing, even though sometimes doing nothing is the best thing to do. Because of these costs and problems with brokers acting in their own interest, it's best to stay away from brokers who give advice. Instead, check out discount brokers. These are cheap services that just do the trades you ask them to. They don't try to sell you more stuff or give you advice you didn't ask for. And if you want a simpler, easier way to invest, think about index funds. These funds are made to copy how a certain market index does, like a list of the best stocks. One of the most famous indexes is the S&P 500, which follows 500 of the biggest companies in the US. It's put out by SP Global, a reliable financial company. When the economy gets better, the SP does too. When the economy gets worse, the index might go down. But the good thing about index funds is that they don't need someone to manage them all the time. Many of them are even run by computers, which makes their fees very low. Putting money into index funds and using dollar-cost averaging, where you invest a set amount regularly, can help you do better than many experts over time. No need to trade all the time or make choices based on feelings, just steady and consistent growth. Hot tips, inside information, and other details. Once you start investing regularly, you won't just stick to bonds, mutual funds, or regular stocks. As you learn more, you'll find other ways to invest, some fun, some risky. But before you start, here are some important things every smart investor should know. First, never just believe investment tips or hot information, no matter who tells you. Politicians and important people often invest based on special information that the public doesn't have, which is called insider trading. It's against the law for a good reason, and most likely the news your friend tells you is already old. The dangers of chasing returns. It's tempting to chase after high returns, but this can be risky. High returns often come with high risk. You might see an investment that seems to be doing very well, but it could also drop quickly. It's important to think about how much risk you can handle and not just focus on the potential rewards. Understanding investment costs. Every investment comes with costs, such as fees and commissions. These costs can eat into your returns over time. Be sure to understand all the costs involved before you invest in something. Look for investments with low costs to help you keep more of your money. The importance of diversification. Don't put all your eggs in one basket. Diversification means spreading your investments across different types of assets, such as stocks, bonds, and real estate. This can help reduce your risk because if one investment does poorly, others might do well. The long-term perspective. Investing is a long-term game. Don't expect to get rich overnight. It takes time to build wealth. Be patient and stick to your investment plan, even when the market goes up and down. Why diversification matters more than ever. In today's fast-changing world, diversification is more important than ever. The markets are more volatile and new risks are always emerging. By diversifying your investments, you can protect yourself from these risks and increase your chances of achieving your financial goals. How to diversify your portfolio? There are many ways to diversify your portfolio. One way is to invest in different types of assets, such as stocks, bonds, and real estate. You can also diversify within each asset class by investing in different companies, industries, and countries. Asset allocation. Asset allocation is the process of deciding how to divide your investments among different asset classes. The right asset allocation for you will depend on your individual circumstances, such as your age, risk tolerance, and financial goals. Rebalancing. Rebalancing is the process of adjusting your asset allocation back to your target levels. This is important because your asset allocation can drift over time as some investments do better than others. Rebalancing helps you stay on track with your investment plan and manage your risk. The role of bonds in a diversified portfolio. Bonds are an important part of a diversified portfolio. They tend to be less volatile than stocks, and they can provide income. Bonds can also help to protect your portfolio during market downturns. The importance of staying disciplined. The key to successful investing is to stay disciplined. This means sticking to your investment plan, even when the market is volatile. It also means avoiding emotional decisions, such as buying high and selling low. The pitfalls of emotional investing. Emotional investing can be very costly. When you make decisions based on fear or greed, you're more likely to make mistakes. It's important to stay calm and rational when investing and to focus on your long-term goals. How to avoid common investing mistakes. There are many common investing mistakes that people make. One mistake is to try to time the market. Another mistake is to chase after hot stocks. The best way to avoid these mistakes is to do your research, stay disciplined, and focus on your long-term goals. The power of compounding. Compounding is the process of earning returns on your returns. It's a powerful force that can help you build wealth over time. The earlier you start investing, the more time your money has to compound. The importance of starting early. The earlier you start investing, the better. This gives your money more time to grow through compounding. Even small amounts of money can add up over time. How to get started investing. If you're not sure how to get started investing, there are many resources available to help you. You can talk to a financial advisor, read books and articles, or take online courses. The most important thing is to start. The benefits of working with a financial advisor. A financial advisor can help you create a personalized investment plan, manage your risk, and stay on track with your goals. A good financial advisor will act as a fiduciary, which means they are legally obligated to put your interests first. How to choose a financial advisor. When choosing a financial advisor, it's important to do your research. Ask for referrals from friends and family and check the advisor's credentials and experience. Be sure to understand how the advisor is compensated and make sure you feel comfortable working with them. The importance of financial literacy. Financial literacy is the ability to understand and use financial information. It's essential for making informed decisions about your money. There are many resources available to help you improve your financial literacy. How to improve your financial literacy? There are many ways to improve your financial literacy. You can read books and articles, take online courses, or attend workshops. You can also talk to a financial advisor or other financial professional. The role of technology in investing. Technology has made investing more accessible and affordable than ever before. There are now many online brokers and robo-advisors that offer low-cost investment services. Technology can also help you track your investments and stay informed about the market. The future of investing. The future of investing is likely to be more personalized, data-driven, and technology-enabled. Investors will have access to more information and tools than ever before. They will also be able to work with financial advisors and robo-advisors to create customized investment plans. The importance of staying informed. The world of investing is constantly changing. It's important to stay informed about the latest trends and developments. This will help you make better investment decisions and achieve your financial goals. How to stay informed about investing? There are many ways to stay informed about investing. You can read financial news websites, subscribe to newsletters, and follow financial experts on social media. You can also attend industry conferences and webinars. The importance of reviewing your investment plan regularly. Your investment plan should be reviewed regularly to ensure that it still meets your needs and goals. You should also review your plan whenever there are significant changes in your life, such as a new job, a marriage, or a divorce. How to review your investment plan? When reviewing your investment plan, ask yourself the following questions. Are my financial goals still the same? Is my risk tolerance still the same? Is my asset allocation still appropriate? Are my investments performing as expected? Are there any changes I need to make to my plan? The importance of seeking professional advice. Investing can be complex and challenging. If you're not comfortable managing your own investments, it's important to seek professional advice. A financial advisor can help you create a personalized investment plan, manage your risk, and stay on track with your goals. How to find a qualified financial advisor? When looking for a financial advisor, it's important to find someone who is qualified and trustworthy. Ask for referrals from friends and family, and check the advisor's credentials and experience. Be sure to understand how the advisor is compensated, and make sure you feel comfortable working with them. The importance of protecting your investments. There are many risks involved in investing, such as market risk, inflation risk, and credit risk. It's important to understand these risks and take steps to protect your investments. How to protect your investments? There are several ways to protect your investments. One way is to diversify your portfolio. Another way is to invest in high-quality assets. You can also use insurance to protect yourself from certain risks. The importance of estate planning. Estate planning is the process of planning for the distribution of your assets after your death. It's important to have an estate plan in place to ensure that your assets are distributed according to your wishes and to minimize taxes. How to create an estate plan? There are several steps involved in creating an estate plan. First, you need to determine your goals. Then, you need to gather information about your assets and liabilities. Next, you need to choose the right estate planning tools, such as a will, a trust, and a power of attorney. Finally, you need to review your estate plan regularly and make changes as needed. The importance of giving back. Giving back to the community is an important part of financial well-being. It can help you feel good about yourself and make a difference in the world. How to give back? There are many ways to give back to the community. You can donate money to charity, volunteer your time, or mentor young people. You can also support local businesses and organizations. The importance of celebrating your successes. It's important to celebrate your successes along the way. This will help you stay motivated and focused on your goals. How to celebrate your successes? There are many. In the end, your money is your responsibility. Financial companies might try to impress you with great deals and ads, but many hide important details or twist the truth, especially insurance companies and investment managers. Here's an example. Andrew Tobias saw an ad for a mutual fund that said it grew by 21.5 each year for the last 10 years. They said that if you invested $2,000 for 20 years, it could become $90,000. That sounds great. But when you look closely, you see the growth rate was not calculated correctly. The fund did have high returns in 6 years, but those were erased by losses in the other 4. So, someone who invested 10 years ago might have lost money. That 21.5 growth number was just a marketing trick. Annual reports can also be misleading. Many people think a company's yearly report is the best way to see how well it's doing. But these reports are really made to make investors feel good. The good stuff is shown big and bold on the first pages. The bad stuff is hidden in hard-to-read charts and small notes. You won't find anything useful unless you know just where to look and how to read it. Now let's talk about some harder ways to invest. One way that's popular but risky is called short selling. Usually you buy stocks hoping they go up in value. But with short selling, you're betting the price will go down. You borrow shares, sell them at the price they are now, and then buy them back later at a lower price. You keep the extra money. The risk? If the stock's price goes up instead of down, you could lose a lot. For example, if the stock price doubles before you buy it back, you lose twice as much as you hope to make. And sometimes, a stock might go up 10 or 20 times its value. This could ruin your account. Short selling can be very risky. Margin trading is another way to increase both profits and losses. With margin trading, your broker lends you money to buy more stock than you could normally afford. But there's a risk involved. The broker holds your shares as security. If the stock price falls too much, they will sell your shares without telling you first. Margin loans also have higher interest rates, usually about 5 more than regular loans from a bank. So, using margin to buy stocks is usually not a smart move. However, it's still cheaper than using a credit card for debt. So, if you really need to borrow money before you get paid, margin loans are the better choice. But use them carefully and not too often. Now, let's talk about options trading, which can make investing more interesting and adaptable. When you buy stocks, it's usually best to keep them for at least a month. But with options, you can trade much faster, even in days or hours. An option lets you buy a stock at a set price by a certain date, but you don't have to. For example, Andrew saw that Merrill Lynch shares were at 16, even though the market had gone up a lot. He thought the stock was worth more. So he bought 10 options. Each option let him buy 100 shares at 20. He didn't have to pay the full 20,000 right away. He only paid $375, which was $37 for each option. This gave him the chance to buy Merrill Lynch shares later if the price went up. And that's what happened. The stock went up to 20, and each option became worth 300. Andrew sold 2 options to pay back what he spent. He let the others go up even more. By the end of the month, he sold all the options at a good price. He made $2,400 in profit without ever buying any shares. What if you think prices will go down? That's where puts are useful. These are options that let you sell something at a set price later on. Imagine a stock costs 75 now. You buy a put that lets you sell it for 70. If the price goes down to 51, you can buy 100 shares for 500 and then sell them for 7,000. You'd make a profit of $1,900. Puts are like a safer way to short sell. The most you can lose is the money you spent on the put. They protect you from losing too much money without taking on unlimited risk. Finally, let's talk about taxes. You have to pay taxes on the money you make from investments. But you can also use losses to help you. If you sell stocks that aren't doing well at a loss, you can make up for gains and pay less in taxes. This is really helpful if you've made a lot of money during the year with short-term gains. If you have some stocks that you don't think will do well, it might be a good idea to sell them at a loss before the year ends. This can help you lower your tax bill. It's called tax loss harvesting, and it's a smart way to make capital gains taxes less painful. As you've now found out, the first step to building real wealth isn't investing. It's saving. Every dollar you save is tax-free and fully yours. Buy in bulk to save money, pay your credit card bills on time, and only buy a car if you can pay for it right away. Always keep track of your loan payments and medical bills. These small habits can lead to big financial security. Second, you've learned that before trying risky things, you must build a strong financial base with safe investments. For now, this could mean putting your money in treasury bills or money market funds. For the long term, you can think about treasury bonds, municipal bonds, and zero-coupon bonds. And if you're ready to get closer to stocks, convertible bonds are a good way to start. Third, you've learned why trading stocks is so important for building wealth over time. It's one of the best ways to stay ahead of rising prices. But when you buy is key. Buy when prices are low, not when everyone is excited. Stocks that everyone loves are often not the best buys because they might not grow much more. Instead, spread your money across different types of businesses and use plans like investing the same amount each month. This helps your investments grow steadily. Fourth, you now know the hidden costs of using brokers and advisors. Most brokers focus on selling, not on understanding the market. Even the best advisors find it hard to beat the market all the time. Really, they often want you to keep trading because that's how they make money. That's why cheaper brokers or simple funds are often better. They keep costs down and make things easy. Fifth, you've looked at more complex ways to invest. Don't just believe rumors or what others say. Be very careful with short selling because you can lose a lot of money very fast. Think of margin loans as things to use for a short time, not for a long time. Learn about options and puts. They keep your risk to only the money you put in. And remember, even losing money can be helpful. Selling things that are not doing well at the right time can lower your taxes and make your money plan better. The stock market might look like a hard thing with risks and chances, but really, good investing is about easy ideas. Know how the market works, keep it simple, think about what you do, and most of all, keep doing it. This short talk has given you the main rules of investing. You now have what you need and the right way to think to make a future with money, safety, freedom, and calm, even after you stop working.